Hi everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of corporate finance. And today we're diving into the MB Asset-Based Credit Fund's latest filings to see what's really going on behind the scenes. This filing with the Securities and Exchange Commission is all about a new fund called the NB Asset-Based Credit Fund. Think of it like a brand new investment company trying to raise money to invest in different kinds of loans and credit-related things. They're telling us all about their plan, their goals, and what could go wrong. This fund is looking to raise money by selling different types of shares. They've got institutional class shares probably for big investors, and then Class A1 and Class A2 shares for others. Each of these share classes has a slightly different fee structure, which we'll get to. The company managing this fund, the one that makes the investment decisions, is called Neuberger Berman Investment Advisors LLC. They've also brought in another company, NB Alternatives Advisors LLC, to help out. Together, they're the ones calling the shots on where all that invested money goes. So what's the main goal here? The fund wants to make its investors as much money as possible through current income. That means they're aiming to generate a steady stream of money from their investments, likely through interest payments. They plan to do this by investing in what they call asset-based credit assets. This is a big deal. They plan to put at least 80% of the fund's money, plus any money they borrow, into a specific type of investment called asset-based credit investment. Basically, these are loans or debt that are backed by some kind of asset. This means they're looking for investments that generate regular income like interest payments. They're not necessarily looking for huge jumps in the value of the investments, but more of a consistent cash flow. They're focusing on things like loans to regular people or small businesses, financing for businesses that trade goods, and other financial products that are backed by assets. They also mentioned short duration, which means they're probably not looking to hold these investments for a very long time. Even though they are focused on short duration assets, they're saying this fund is for people who plan to invest for a long time. This is a bit of a contrast and something to keep an eye on. And here's the big warning up front. They're saying this is a risky investment and you could lose money. That's standard for new investment funds, but it's always important to remember. This is a crucial point about liquidity. Unlike stocks you can buy and sell easily on an exchange, these shares are not expected to be traded that way. This means getting your money back might not be as straightforward as selling shares. To try and give investors some way to get their money back, the fund is structured as an interval fund. This means they'll offer to buy back some of the shares from investors periodically, but there are limits on how much they will buy back at any one time. Now let's look at the costs. If you buy the Class A1 shares, you might pay an upfront fee of up to 3.5%. That's like a sales commission. The other share classes apparently don't have this upfront fee, but keep in mind financial advisors might charge their own fees. Then there's the ongoing management fee. They're charging 1.00% of the money they manage every year. The incentive fee is 0% in this table, but they explain it's 10% of the profits above a certain hurdle rate. So if the fund performs well, the managers get a bonus. This number is interesting. They're estimating that borrowing money to invest will cost them about 2.87% per year. This leverage can boost returns when things go well, but also magnify losses when they don't. After all the fees and a waiver that the investment advisor has agreed to, the total annual expenses for the institutional class shares are projected to be around 5.44%. For the other classes, it's even higher. That's a pretty significant chunk of the investment that goes towards fees and expenses each year. They're going to calculate the fund's value, known as net asset value or NAV, every day. This MIV is what determines the price of the shares when you buy or repurchase them. The big part of their strategy involves valuing loans. Since these aren't traded on exchanges, they're using a third-party valuation expert to figure out what these loans are worth. This is important because if these valuations are off, it affects the NIV and the price investors get. The auditors, Ernst & Young, have given their stamp of approval on the financial statements prepared by the company. They say the financial statements are fairly presented, meaning they generally follow accounting rules. Looking at their balance sheet as of June 1, 2025, they show total assets of about $580,000. This is mostly cash and some costs related to organizing and registering the fund. The important number here is the total net assets, which is $100,000. This is the actual investment money they have at this point. It seems like they've only sold 10,000 shares at $10 each to get this going. Their statement of operations shows a net increase of 0 from operations in this early period. This is expected since they haven't really started investing yet. They had some organizational costs, but those were reimbursed, so the net result was 0. A major theme throughout is their intention to be a regulated investment company, or RICE. This is like a special tax status that means the company itself generally doesn't pay taxes on the income it distributes to shareholders. They have to follow strict rules to keep this status, like distributing most of their income each year and diversifying their investments. This is where the risks really start to pile up. They're not afraid to invest in what they call below investment grade securities, which are basically the riskier, lower rated bonds or even unrated ones. They're also open to investing in companies that are struggling financially. This means they're aiming for higher returns, but with significantly higher risk of not getting paid back. A recurring problem they highlight is true lender risk. This relates to the companies that originate these loans. If these companies aren't properly set up or are found to be the actual lender rather than just a partner with a bank, it could mess up the interest rates and the whole legal basis of many of these loans. This is a legal and regulatory minefield that could really hurt their investments. They're also very concerned about cybersecurity. With so much digital activity, a data breach or cyber attack could cause major disruptions, financial losses, and damage to their reputation. This is a modern risk that affects almost all companies today. One of the biggest takeaways is the lack of liquidity. Because these shares aren't traded on an exchange and the repurchase offers have limits, investors might not be able to get their money out easily or quickly. This fund is definitely not for someone who might need their money in a hurry. The fund has a board of trustees, and importantly, most of them are independent trustees. This is a good sign because it means they're supposed to act in the best interest of the shareholders, not just the company. Let's look at the people running the show. Peter Sterling, who heads up the specialty finance team, has a background in asset management and has been involved in various credit strategies. Jongyuan Liu also has a strong background in finance and capital markets. David Kupperman, Jeff Madgett, and Anthony Chutrone all bring diverse experience from finance and investment. The team seems experienced, which is positive given the complex nature of their investments. They're reiterating that they'll offer to repurchase at least 5% of their shares each quarter. This repurchase program is a key feature for investors seeking some liquidity. When I look at NB Asset-Based Credit Fund, I see a strategy that's clearly aiming for higher yields by taking on more risk. They're willing to invest in lower quality debt and companies in distress. This is a high risk, potentially high reward approach. The fact that they're an interval fund with limited liquidity, coupled with the potential legal risks like the true lender issue, means investors need to be very comfortable with the lack of easy access to their money and the regulatory uncertainties. The fees are also a significant factor eating into returns. The experienced management team is a plus, suggesting they know how to navigate these complex markets. However, the overall direction appears to be aggressive, which could be great in a rising market, but very painful in a downturn. In my opinion, this fund is suitable only for investors with a high risk tolerance, a long investment horizon, and a deep understanding of credit markets and potential regulatory changes in the specialty finance industry. They should also be comfortable with the upfront fees and ongoing expenses. It's a specialized vehicle, not for the faint of heart or those needing quick access to cash. Alright, that's a breakdown of NB Asset-Based Credit Fund's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.